Okay, perfect. So thank you everybody for joining. I know my lighting is not the greatest today. But today we're going to essentially speak about protection options and also estate planning. So to kind of give you an idea of the topics that we'll be covering today. So when it comes to finances, we look at finances like a house. So let me actually go back a slide. So we start with the foundation of the house, which is the protection. Without a proper foundation, you won't be able to build a solid house on top of that. So the all the topics that we will be talking about today is under the protection aspect for this specific presentation. There is accumulation, so it's how you grow your assets, and then preservation and legacy, which we will also be talking a little bit about today, is essentially how are you taking your assets out in retirement and how are you passing it on. So that kind of ties in with the estate plan a little bit. The estate plan kind of covers, it falls under protection and preservation, so it ties it together, but we will be focusing a lot on the protection aspect today. So if this will go to the next slide. Okay. So under the protection, what are the things that need to be considered? So as you can see here, here are a few things that will be considered in the, when you're looking at protection. The things that I will be talking in depth about today is the estate planning. So that will be wills, powers of attorney, trust, your first two tiles there. So that we'll be talking a little bit more towards the end of the presentation. Emergency savings, debt management, but all I want to say about that is, you should have a good size emergency savings, usually about 3 to 6 months worth of your monthly expenses should be fully liquided in emergency savings in case of, with everything happening, the economy just changing on honestly every second. You do want to keep those emergency savings not invested into anything, just purely in a savings account for situations like that. Charitable donations, I'll just briefly touch on it right now. So you can donate to charities. It helps with your tax bill, it helps with deductions, and it helps with legacy too. Now, how you pass it on, it depends on, what product you want to put into. We'll touch a little bit about it on estate planning, but not the focus. But if you want to pass some of your assets down to a charity, there are tax, what do you call it? There are tax benefits to it. Health insurance, home auto insurance. Well, what I will say with that, so health insurance is you should have it. Most of you should have it through your employer. If not, individual plans. Is there anyone on Medicare in this group? Anyone going through Medicare? I can't see
Yes.
everyone.
Yes.
Yes. Okay. So for Medicare, we'll be touching a little bit about it on when we talk about long-term care insurance. But for Medicare, if you are on Medicare, you do have to watch out for what you take out of your IRAs because that will affect your Medicare premiums. And if you're not happy with your Medicare premiums, there are supplemental plans you can take advantage of that could be more cost effective. So the IRA stuff I will talk about during the estate planning section, but Medicare can be affected by your income. It can be affected by your what you take out of your IRAs and your 401ks. And if you are looking for cost-effective solutions, there are supplemental plans that can help with that. Home and auto insurance, what I'll say to that is you just have to have it. There's no other way around it, especially with everything, with the natural disasters, all that, you just have to have it. Just make sure you're in good standing with it. There are a lot of policies that are getting canceled and all of that. Just make sure you're good in standing. Make sure you know your coverage. Make sure you know what's covered in this situation of a disaster because you don't want to find out what you're not covered for after the disaster happens. You want to know beforehand. So that's what I'll say to that. And then disability income insurance, this is mostly if you are with a employer, they most likely will offer this to you short-term and long-term disability. Highly recommend taking advantage of it if you have it with your employer. Because what this does is if you are disabled, you will still get a paycheck. So if you have someone who's dependent on you or multiple people who are dependent on you, and you're not able to work for a certain period of time, that loss of income can be, certain times catastrophic to families. Bills are not able to be paid. So this is something, and usually if you have it with an employer, it's very, very, very non-expensive at all, because employers do offer this at a very steep discount. Now, if you don't have it with your employer, you do have the option to purchase this, for yourself. So this is because I know a lot of people might be thinking, oh, Social Security will give me disability, which yes, that is an option too. I don't want to discredit it, but the thing with Social Security disability is it's very, very hard to qualify for, and it does take a while to get it. So this is guaranteed. Like if you say you're disabled in the terms of the policy, this will pay out for sure. Versus Social Security, you do have to take a gamble, which unfortunately anything with any government aid, there is a little bit of a gamble and a wait time too. And unfortunately, bills do not wait. So this is something, if you don't have it with your employer, and you do have people who are dependent on you, and your income, something to consider getting for yourself. And then the last two tiles, I'll actually be jumping right into life insurance and the different types of life insurance in the next slide. And then we'll also talk about long-term care insurance and planning for that. So I'll keep questions towards, I'll have like questions in the middle of each part. But yeah, after I talk about the life insurance, I'll take some questions. So, all right. So why do you need life insurance? There is a lot of clicks here. So essentially why you need life insurance is to protect yourself if you are working and you have assets, you have debts, you have loans, you have someone who's dependent on you, who's dependent upon your income. That's what the life insurance is for. Also, after you pass, which kind of ties into the estate planning, after you pass, there are costs when you transfer wealth, which we'll be diving into deeper in the estate planning section. But there are definitely costs when you're passing on wealth and after you're passing. So having a liquid asset that is also tax advantaged, because any death benefit is tax-free, it's paid tax-free to the beneficiary, will be a huge help to those, taking care of those expenses and whatnot. So here are some misconceptions about life insurance. You only need it at a certain point, all of that. So we'll when we go through the different types of life insurance, you'll kind of see why these are misconceptions. Okay. So in simplest terms, there's two basic types of life insurance. There's your temporary coverage, and then there's your permanent coverage. So when you're talking about temporary coverage, you can kind of compare this to a house like it's doing in the presentation. So this is your term life. That's the only type of temporary coverage there is. So you're buying essentially coverage for yourself for a certain period of time. So say 10 years, 20 years, 30 years. It does not build any equity. It's literally if something happens to you in that given time, the life insurance will pay out. So it's essentially just a temporary protection for your family. And because it's temporary, this is usually the most cost-effective option. Now, most people do want to outlive these policies. They don't plan on passing away in the next, especially if they're younger, in the next 20 years or 15 years, especially if they have a young family. So usually people purchase this for the cost effectiveness because they need a lot of coverage, but their budget is a little bit smaller. But then when you're talking about legacy and building equity through life insurance, that's where the permanent life options come in. And there are a few types which we'll go into. And the main reasons people use permanent life before I go into the different types is one, to guarantee a legacy for their children, or their heirs or charity or whatever it may be. Because temporary, if you outlive the coverage period, nothing pays off. So you're not guaranteed a death benefit versus permanent, you are guaranteed a death benefit. They are guaranteed a payout. And then it also most permanent policies build a cash value in it. So if you need to, take out money, from the premiums you put in, depending on the type of product you're in, you're able to do that. And that's essentially, another tax advantage, which I'll get into when we talk about the different types. So people use it to build equity for themselves and guarantee a legacy using the permanent life. Now, we did talk about the term. So what types of permanent life insurance are there? So your most traditional option and your most the option that's been around for the longest time is something called whole life. And just like the name suggests, the product is with you for your entire life. So what it does is you start out with a death benefit coverage, and that death benefit goes up every year. And not if, but when you pass away, that will be paid out to whoever your beneficiary is, or if it's a trust or a charity or whatever it may be. So that, and then the other big benefit with the whole life is it's building equity. So what that means is there's a cash value built into it. And the premiums you put in, a portion of it goes into that cash value and it grows based off of dividends. So, that's what it says here. So your cash value is growing like any other fixed investment account. So that's accessible to you during your lifetime. Now, the main advantage with investing through life insurance is the tax benefits. So your death benefit is tax-free. So your beneficiaries do not have to pay any tax on it. So that's why it's very, very popular to use this to pass on wealth. And then the second thing is the cash value. If you use it during your lifetime, your gains are now tax-free. So it's very similar. If you guys have heard of a Roth account, very similar. So this is where you're building your equity and building, whether it's whatever fund it could be, a retirement fund, I don't know, a wedding fund, travel fund, whatever it may be. You can use that cash value for that. And, that's something available for you tax-free. And this is one, if you're not eligible to put into a Roth IRA, this is really the only tax-free vehicle that the IRS allows. So that's whole life. There's something called universal life. Now, this is termed as a permanent life product. And like the whole life, it does have cash value. The death benefit doesn't go up though, that stays steady throughout the policy, but there is a cash value. The benefit to this product, unlike whole life is probably your most expensive out of the life insurances, because you get the most benefits. Universal life is a slightly less cheaper, and you're a little bit more flexible when it comes to paying the premiums. But the reason is the point of universal life isn't to use the cash value like whole life. This is something that, usually term life, like we talked about in the temporary coverage, the highest term life coverage you can get is about 30 years. You're not going to get any more than that. So they introduced this universal life product to essentially give you coverage for 40, 50 years at a cheaper cost than whole life. And that's why using the cash value is not recommended in this option. So you do have the same tax advantages as whole life. You have all of those You can take out the cash value if you like, but these have to be funded correctly. And if you take out the cash value, you can lapse the policy sooner than expected. So this is a little bit more complicated. It's not really meant for the investment. It's really meant for like a longer period of coverage than what a term life can offer you. But it is cheaper and it is more flexible. So if someone is just looking for life insurance coverage, but term is too short for them, this is what we would recommend. We would not recommend this for investment purposes for most of the time, unless there is a special circumstance. We will, but most of the time we don't. This also goes for index universal life. If anybody has come across that product, that one is actually a little bit more complicated than universal life. And same thing, the purpose of it is the life insurance coverage, not the cash value. So the last type is something called variable universal life. So this one, very similar to your whole life in terms of the tax advantages, the cash value, and the death benefit. But now instead of being only fixed and dividend participating, this one actually gives you market exposure. So you can kind of compare this to a Roth IRA account. I mean, I don't want to say it that because Roth IRAs don't have a death benefit that comes with it. But when it comes to just the cash value, it's tax free, but it's now growing directly. You can invest in stocks and bonds, and it will grow that way. So a lot of people, if they are not able to contribute to a Roth IRA, they use this because this is really their only option that they can put into the market and get the tax advantages or the tax-free growth. So those are your types of life insurance. You have the term, we went through the term, temporary coverage, and the permanent. So essentially, to kind of sum up the life insurance part of it, what is the right coverage for you and what is the right product for you is case by case. So we essentially help you, decide like, okay, what needs to be covered? What are your goals? What are you looking for with life insurance? And we tie it into the estate plan as well to see what best fits. But I'll stop for a few minutes for any questions on the life insurance that we talked about so far and the types of life insurance. Any questions? No? No questions. Nothing in the chat either, because I don't think I can see the chat.
There's nothing in the chat. I guess we'll take questions closer to in another section.
Okay, sounds good. So I do see a question.
Yeah, now we can go to raised hand.
Yes, go ahead.
Okay. Do these earn interest?
So yes, those are your dividends. So that's your interest on the cash value, or if you're invested, so that's for the whole life and the universal life. If you are invested directly in the market with the variable product, now you're just getting the gains based off of the market performance.
Right. But what about the other type? Do they tell you up front a certain amount?
Yes. Yes. So there is a certain minimum interest that is guaranteed in the product. So whether it's universal life or whole life, there is a certain guarantee. And then there will be, for the whole life, it's dividend participating. So you can essentially get more than than what the guaranteed amount is, but there is a minimum guarantee.
Okay.
Does that answer the question?
Pretty much. I mean, unless you can give an example of.
Okay. Yeah. So, okay, let me just, this is, okay. So for example, for the whole life policy, the guaranteed, most of the policies that I've seen, the guaranteed minimum interest that the cash value has to receive is 4.5 every year. So no matter if the company doesn't announce dividends, nothing, they have to give you 4.5% on the cash value every year. Now, that same company has been paying about 6.2%. That's actually what they're paying because they are announcing dividends. So they're paying actually 2% higher than what their minimum guaranteed is. Make sense? Okay. And that's only for the fixed. Now, the variable does not have any guarantees. They do have protection so that if the market really tanks, that your coverage doesn't lapse. But when it comes to the cash value growth, there's no minimum guaranteed because you are participating directly in the market. So it's only the fixed ones that have the minimum guaranteed, and you can get essentially more. Any other questions on the life insurance? Yes, no, maybe. We're good? Okay. So going on to long-term care coverage. Yes, everybody can see my slide, right? Yes. Okay. Oh, I did. Okay, before I go on, I do see a question. Can you give an example of a layered insurance portfolio? Oh, that's, for example, if you have the most common layered insurance portfolio is if you have a few term policies and like maybe a whole life. So people start with term policies because they are cheaper. So they buy a few of them. They're like, okay, they buy for cost effectiveness, they buy a 10-year, a 15-year, and a 20-year so that they can maximize their coverage. And as they age, their needs for life insurance decrease. So when the 10-year expires, like they're not worried about it. They still have their 15, 20-year and so on and so forth. But what a lot of people do is over time, they actually convert some of that term into whole life because you can do that without a health examination. So that's one of the benefits for getting term sooner. You can essentially lock in your health and you don't have to worry about qualifying health-wise for life insurance. So a lot of people do that. They, cost effective in the beginning and they transfer it over into whole life. But yes, people layer just for it helps budget-wise when it comes to the term. And they know like, okay, for 10 years, I need this much coverage, but then I don't need that much for 15 years. So some of it falls off and so on and so forth. Does that answer the question, Michelle? Yeah, okay. I see a thanks. Okay. All right, moving on to the next. So the next tile that we're going to talk about is long-term care and long-term care strategy around it. What is it? And possibly protecting yourself against it. So what is long-term care planning? So that's planning if you need to be taken care of in your older years. So if you need assisted living, if you need someone to take care of you in your home, that's what long-term care is for an extended period of time, obviously. So why should you create a long-term care strategy? So mainly it's to protect yourself, protect your family, and protect the funds that you have. Your retirement funds, your home, all of that. Because without a strategy, a lot of people's funds get depleted very fast because they don't realize the cost until it's too late. They don't realize what they may or may not need until it's too late. And it really depletes the funds of that person, and the family may have to chip in too. So planning ahead will give you that peace of mind. So by definition, what is long-term care? It's essentially if you need help with these basic services to live. So usually the definition is if you can't perform 2 out of the 6 activities of daily living, you are in need of long-term care. Whether it's at your home, whether it's as a facility, that doesn't matter, but that's the basic definition of long-term care. Now, this also, if you do have a a mental condition like dementia, Alzheimer's, all of that, that also counts. Even if you can do these things, but you have that condition, that also counts as needing long-term care. And we see actually a lot more cases with that than the physical stuff nowadays, actually. So this is a normal part of aging. So statistically, how many people need long-term care? So, I mean, it might shock you. It's about 70% of Americans, 65 plus, will need some time of long-term care in their remaining years. Pretty high number. We never want to use it, but you know, if we're not planned for it, it can be a huge burden onto families, not just financially, emotionally, mentally, time-wise, all of that. I see a lot of my clients, they come to me, they're like, oh, I want to, you know, plan for this because my parents didn't. And, you know, we had to do all of this and we didn't know. So I wouldn't want my children to go through that. So I see a lot of people who come to me, they want to, you know, protect their children from, you know, just kind of figuring it out as it happens. So for the long-term care strategy, I mean, if you guys want to kind of be like a little activity, go along with me. These are the things that need to be considered when you are creating a long-term care plan. So who is going to be taking care of you? Where would you want to receive your care? How much does that cost? And then what's the best solution for you? That's where we kind of come in and we kind of, put everything together at the end. But you need to know like, okay, who, where, and how much do certain, and you can have more, like you could be like, oh, at a certain stage, I want, you know, this person to take care of me. But if I do go to, if I need more care, it has to be a skilled professional. So you need to know the cost of both. And where, you know, a lot of people do want to age in their home, but at a certain point, it may not be feasible to age in their home depending on their health. So how much does a facility cost? So that's kind of, it's like, if you have an idea of like what your wishes are, it'll be much better to plan for the long-term care situation. So if you want to kind of, you know, draw this on your piece of paper and go along with me, that is totally fine. So the first question is who? Who's going to do it? Is it going to be a family member? Is it going to be a skilled physician? Is it going to be a skilled nursing person? Any of that? If it's going to be someone who's a family member or friend, like a non-skilled professional, you want to make sure they know that you know you expect them to do that and that they are aware of their their responsibilities and all of that. Now there are certain things that a non-skilled person cannot do, so then you would have to get a home care facility or a skilled person to your home. So that's the who. But yes, if you do prefer someone that is not a skilled person, you do want to communicate that with them. Because here's some, like shocking, I guess, statistics per se. Like percentage of caregivers who work while caregiving, 61%. That's a huge burden. A lot of people I have heard have to quit their jobs to take care of a person, which then that's a loss of income there. Percentage of caregivers who have experienced at least one financial effect as a result of caregiving, 45, almost half. That's quite a bit. And then out-of-pocket costs. And then here are a little bit more statistics. So if it's going to be someone who's non-skilled, like I said, it needs to be communicated with them. They need to know their responsibilities. And at what point do you need a skilled person? And how much will that cost? Second question, where do you want to be taken care of? So a lot of people, it's at their homes. 90% is at a home or in their community somehow. So usually home care does cost more than being in a nursing home. So something to consider. So that's the where section if you want to fill that out. And then ultimately, how much does each cost? So here's a little table of the national averages. So if you are in home care, this is kind of their thing, 1 bedroom assisted living and nursing home. So these are the costs as of now. These are going up. They are going up with inflation. So what is, how will this be covered? Here's a little QR code. You can actually look up on this website, you can look up the cost for Southern California. I think most of you guys are out of Southern California, so you can look up by location what the cost of these different care is. So that's your cost. Now, what's the solution? So there are multiple ways to fund your long-term care. Here are a few ways. So the first one, Medicare and Medi-Cal. So Medi-Cal actually does fully cover long-term care if you qualify for it. So if you qualify for Medi-Cal and for their full benefits, which I know it is, and now it is hard to do, you are fully covered for long-term care expenses. So keep that in mind. Medi-Cal fully covered. Medicare, I know there was a few people on Medicare on this call. Medicare does not cover long-term care costs. It only covers it for the first 90 days. And then after that, you're on your own. It did used to in the past. So Medicare, you may have heard it covered, it did used to in the past, but now there unfortunately isn't enough funds. So Medicare does no longer cover long-term care. And if you have any private health insurance, that also does not cover long-term care either, because health insurance covers medical expenses, so hospital-related expenses, those. So long-term care does not fall under that. So if you do have private medical insurance, a supplemental plan, a Medicare plan, any of that, those do not cover long-term care coverage past the first 90 days. So your other way essentially is, you can go out of pocket. Now, this, you do have to be careful because, all of your assets can be depleted fast. But yes, out of pocket can help with the cost. So if you have personal savings, income, investments, and then what a lot of people forget is the reverse mortgage. So you can, for those of you who are a little bit older and you want to age at home, you have the opportunity to take a reverse mortgage out on your house and pay for the long-term care expenses. So that's something, a nice little tool that is usually missed out on. So yes, if you're in home, you can take advantage of this. So to hedge, I guess, alleviate the cost of coming out of pocket, that's where you have private long-term care insurance coverage. So most of the time, people don't fully get covered by long-term care insurance just because of cost, or they waited too long or whatnot. But at least if you can get a percentage of your costs covered by your insurance, you can save more of your personal assets and, use it down the line, or you have more to pass on to your next of kin. So this way, if you use this as a hedging strategy, you can save more of your personal assets. So speaking of insurance, this is a lot of the stuff that I already went through. So this is what I talked about, the hedging. So if you just use your personal assets, if you come out of your income, that's going to affect your lifestyle. If you take out of your 401ks, IRAs, there will be tax consequences. You do have to pay the tax. If it comes out of your savings, then you're just depleting your savings. There's no leverage. So what kinds of long-term care insurance are there? Now, I know a lot of people have heard of the traditional long-term care. It's been a product that's been around for a very long time, although a lot of people are not a fan of it anymore because it's a use it or lose it. Now, this is technically the cheaper option, but you do have to pay until you make a claim. And if you don't use it, it's kind of like car insurance. It's great. Like when you get into a car accident, if it's there, great. But if you don't use it, it's just like, why am I paying these premiums? So the insurance industry as a whole saw that, and they were like, and a lot of people were not getting long-term care coverage because of like, I don't know if I'm going to need it or not. So why am I going to pay into it? So the insurance industry created a hybrid product as for people who wanted that flexibility. You don't have to pay into it forever. There's a specific amount of time you can pay into it, and you have a cash out option. So if you're like, I'm not using this at all, I don't see myself needing it in the future, you can cash out what you put in. Or if you don't use it and you pass away, it will pay as a life insurance to your family. So one way or another, the money will come back to you. So it is slightly more expensive, but on the whole, people actually put less money into this than this. The coverage is still the same on both. You're going to get covered with in-home care. You're going to get covered with, nursing facility, skilled facility, wherever you go. Both of these policies will cover, but what a specific person needs and what is better for them is, that's where we kind of have those one-on-one conversations. But I know there's a misconception, long-term care, yes, you have to pay into it forever. It's crazy expensive. And if I don't use it, I lose it. That actually does not exist, or that's not a thing anymore. Like if you go the traditional route, yes, that is that's the more cost-effective option, but there are more flexible options out there for long-term care that are surprisingly not as expensive as people would think they are. And that's where we kind of customize the plans for the clients. So this just kind of goes into a little bit more depth of the advantages. So another big benefit that the long-term care insurance provides, and this is with, the majority of carriers, is you actually get assigned someone to, and I think there's a slide on this. Here we go. Yes. You actually get assigned a team to help your family navigate everything. So they help you find a good nursing home. They help you find all of that stuff. So that's a lot of people just have small policies just to get that benefit. Because when you are in that situation, your family, they may, they're not experts in the best nursing home or the best care or whatever it may be. And they're already, dealing with probably other things in their life. So without this help, it is a lot to put on your family's plate. So just having these policies, it takes that off their plate, and you do have someone to essentially help your family find everything that they need, make the payments, make sure nothing is behind, all of that. So that's a huge relief for the family. And that's something when you do the planning, it's like, okay, I do have a policy. Hey, this is the benefit that comes with it. That's something that should be communicated to the family so that they are aware of it and they can take advantage of it as well. So kind of in conclusion, when it comes to long-term care is, okay, this is where it kind of, the conclusion is, okay, what are the costs that are associated with, being taken care of? Who do you want to take care of you, or at least, organize everything? And how are you going to pay for it? So do you have assets? Do you need it to be hedged with insurance? All those things that we talked about. So I'll stop here for questions before I go into the final section of estate planning. And this also, keep in mind, the life insurance and the long-term care, it helps with your estate planning as well, because, if you have coverage, you're saving more assets that you can pass on to your next of kin. And then, of course, life insurance, there's the death benefit. But yes, Carmen, I see your hand raised up.
Hi. So I have a question. I have both whole life insurance with long-term care rider and term with long-term care rider. I just want, as you said, my term is 20 years and I
Mhm.
still have like maybe 15 years
Yeah.
to go. So you said that uh, at what time can I switch it to a whole life?
You can
And
switch
is the rider, it can
Mhm.
be transferable too?
Yes. So, well, first, I did want to answer the first question. So, you want to make sure your rider is not a chronic care rider, but actually a long-term care rider, because there's two different. And I know there is people who, they sell them as the same, because chronic care, it can actually cover certain long-term care things, but not all of it, right? Chronic care, for that rider to kick, you have to kick in, you have to have a chronic illness, and there's a list of it, right?
Yes.
So long-term care insurance, if you just don't have, you can't do 2 out of the 6 activities of daily living. You don't even have to have any chronic illness. That's where the long-term care kicks in, right? So usually life insurance policies have chronic care rider.
Mhm.
I haven't seen anything have a long-term care rider. So you may want to double check and just read through your policy, and the terms and conditions of it. Because if you have a chronic illness, usually you're going to need long-term care. So that's okay. But sometimes if you need long-term care, but you don't have a chronic illness, that's when you start getting into trouble with those riders.
So does
So
the life insurance companies provide long-term care insurance
yes,
rider?
yes, we do. Yes, not all, most life insurance companies provide all types of long-term care insurance. Yes, but then you just want to keep in mind that, because I deal with this in our life insurance policies, we have the chronic care rider, and I have seen a lot of people sell that chronic care rider as long-term care, which in theory it's not. Like I said, it's like all. Wait, okay, I want to get this right. All rectangles are squares, but not all squares are rectangles. I think hopefully I didn't say that backwards, because chronic care. So yeah, if you have long-term care, if you have a chronic care need, now that rider is going to kick in because you have a chronic illness and you're going to need long-term care. But
Okay.
say you just need I don't know, you tripped on the stairs and you fell and you broke your hip. Now you can't eat, bathe, and dress yourself by yourself. That's not a chronic illness. So your chronic care illness rider is not going to kick in. Only if you have a long-term care policy will it kick in.
Good. Okay.
Yes. So just to keep that in
Yes.
mind, so I would definitely highly recommend reading your policies,
Sure.
and this will, like, the distinction will be mentioned in your policy documents.
Thank you.
And then, well, your second question, yes, you can convert term life into whole life at any point. You don't have to, there's no waiting period to convert.
Perfect.
So yeah, you can convert at any point, and any riders you have, they'll come with you too.
But it should be before that expiration date.
Before the
Before
expiration
the
date.
term. Okay.
Yes. Because if it's expired, it's no longer active. You can't do anything with that policy. So before expiration date, you can convert at any point, and the riders will come with you. Yes.
Thank you so much.
And then I have a question on the chat from Tatiana. Okay, you probably are going to have to read this question to me. Medical that disabled person has cover or not long-term care? I don't think I understand the question.
Tatiana, do you want to clarify?
It's okay. I can move on whenever she wants to chip in. And
Yeah.
then from Deborah, at what age should you buy long-term care insurance? Honestly, any insurance, the earlier, the cheaper you're going to get it, obviously. But to get the most benefits, what I'm seeing, a lot of people buy it in their 40s to 50s is a sweet spot. But I have a lot of clients in their 60s still getting long-term care, and they're still getting good amount of coverage. So really it's better to get it at any point, but 40s to 50s, I would say the sweet spot, but 60s, definitely still not too late. I've seen a lot of people get coverage even in their 60s. And yes, Tatiana, but didn't mean to cut you off, but go ahead.
My son has a medical. He is disabled, Down syndrome and diabetes. Is his medical cover long term or not?
It depends. Does he have like private medical or through like
No,
Medi-Cal or Medicare?
through medical, through government, no
Yes.
private.
Okay, so if it's through Medi-Cal, like I mentioned, Cal, not care, Cal covers long-term care. So that 100% Medi-Cal covers long-term care insurance. So as long as he qualifies for Medi-Cal and he stays on it and he needs long-term care insurance or long-term care in the future, he will be covered. As of right now. Now that can change in the future, but as of right now, that's the situation right now.
Thank you.
Yeah. Any other questions on long-term care insurance? Oh, yes. Go ahead, Carmen.
So my question is if, for example, when I get older and I have, for example, Medicare, okay?
Uh-huh.
I have both Medicare and Medi-Cal. And
Yep.
then if I need long-term care and the
Mhm.
Medi-Cal knows that I have this rider, is it going to refuse to pay or how is it working?
Oh, no. So they're not going to refuse to pay. What they will do is they may so your Medi-Cal is going to kick in first. Now, if there is what do you call it? If Medi-Cal say doesn't cover certain things, which at the moment that's not the case, but if they, say you need a specific equipment that Medi-Cal doesn't cover, but your rider does, then that's kind of, you can use a little bit of both. So it's not, you can have as many long-term care policies as you like. They usually kind of pay in succession. But since Medi-Cal covers 100%, Medicare is not going to cover anything. Medi-Cal, if you have any expenses that are not covered by it, you can see if you can use your rider to cover any expenses that maybe Medi-Cal, there's anything specific that they left out, like an equipment or something like that.
Mhm. May I ask
Yeah.
my last question?
Yeah, absolutely.
For the chronic long-term care,
Uh-huh.
it is specified that a health professional, like a nurse or someone that has, license, they can come and provide services, and then they are going to reimburse them. What about the regular long-term care, not the chronic one?
Yes. So when
So
it comes
anyone
to,
can be?
yeah, yeah. So it's going to be this, when it comes to reimbursement, as long as you qualify to get paid out, they're just going to reimburse whoever it is coming to take care of you.
For long-term, not the chronic one.
No, for both, for both. So if that's the thing, chronic, if you're able to get it, like you have a chronic illness and that's why you need the long-term care, that coverage will kick in. And yes, there will be a reimbursement. Now, keep in mind, that's going to decrease your death benefit too. So that's another thing a lot of people miss out on. For the chronic care rider, if you use it, it's going to decrease the life insurance or the death benefit that gets passed on. So that's another thing to keep in mind. You can't use the chronic care and expect your next of kin to get the full death benefit. So something to keep in mind versus long-term care. Yeah, if you just have a long-term care policy, no chronic illness, you just need the long-term care, that will also be reimbursed. But since that will be a separate policy, that's not going to affect any existing life insurance that you have.
Okay.
Yeah.
Thank
Yeah.
you.
So yeah, both of them are reimbursement style model.
Thank
you. Okay, yes. Any other questions? I think you know what? I am gonna jump into the next slide. I'm just looking at the time. So yes, the last section that we're gonna kind of go over is estate planning. So in this section, we're gonna talk about essentially why you need an estate plan. What are certain basic structure of the estate plan and how to pass on your assets in the most tax favorable way. So to answer your first question, what is an estate plan and who needs it? Now, estate plan basic is to avoid probate. To avoid probate and to pass on your assets as you please. Because if you don't have a basic estate plan, it is going to go into probate, which is very, very expensive and very, very costly. But also the state gets to decide who gets what of your assets. And that's maybe not something that you would have preferred. So that's where you write up documents like wills and trusts and other documents, which we'll go into, like power of attorneys, all of that, to make sure your wishes are met. You're doing it in a tax advantaged way, and your assets don't end up in probate, because if it does end up in probate, not only does it take a while, there's a 2-year waiting period in California, but then it's also very expensive. Like the court will take a certain percentage of your assets just to pay the attorney. It gets very expensive depending on how much assets you have. So I like to say, like, if you have a house in California, you need an estate plan. You need at least a basic will and trust, because one house already exceeds the threshold for you to go into probate. So, like I said, estate plan is, your wishes, who you want to get the assets to, how much, all of that. And then it's also protecting yourself and your legacy and implementing tax reduction strategies. Everyone has an estate, so everyone needs to protect it. It's not just a wealthy, like, back in the day, there was this misconception that you only needed an estate plan if you were very, very wealthy. Not the case anymore. You have a house in California, you're already above the probate threshold. So, let's see. All the things we already talked about. So another thing you do need an estate plan is the cost of transferring wealth. So there is certain taxation, which I'll talk about in a later slide. If you're passing on wealth, depending how you're doing it and how much you have, there are certain costs to it. So whether it's tax, whether it's just implementing the trust. So are you ready for those expenses, and are your heirs ready for those expenses, and do they have the assets to satisfy those expenses? So yeah, we'll go through the estate tax briefly. This is one of the biggest ways people get their estate tax. So when you pass, if your estate is higher than a certain amount, the IRS will come and tax you, and it's 40%. Now, right now, that threshold is $15 million. Most people don't fall in that threshold. So, I don't want to say it's not something you don't need to worry about, because the thing is, Congress can pass something to bring that threshold down, and it can catch more people, because it has been low as like 1 million, 2 million in the past. And with how much houses are appreciating in California, it catches a lot of people. So right now it's 15 million. So if you have less than $15 million in assets, you don't have to worry about the estate tax. But you just have to keep in mind, like, okay, work with someone. If it does go back down, are we prepared? Do we have, enough liquid assets to pay this, so on and so forth? Then how is it being passed down? So yeah, and then yeah. So estate plan. Here are the different, what do you call it? The different sections of an estate plan. So how are you protecting yourself? How are you protecting your legacy? Tax reduction strategies, and then of course implementing it. That's where we come and help you. So how are you protecting yourself? This is part of the estate plan. So that's where the powers of attorney come in. So if you do become incapacitated, or you're not able to be reached, or something like that, you do assign someone to take care of your finances in that meantime. And you want a durable power of attorney rather than a regular, because if you do become incapacitated, a regular power of attorney expires. So even if you do have someone with the power of attorney and you become incapacitated or mentally incapacitated or something, that power of attorney doesn't exist anymore. So that's where the durable comes to protect in those aspects. And then the healthcare power of attorney, that's the person who will be assigned to take care of any medical decisions at end of life, which you can also have written down what your wishes are at end of life, and they can execute it. So you would need a healthcare power of attorney as well. And then the living will, that's how you, that's where you essentially tell people or, say like, how do I want my assets to be split up? So that's where that comes in. And buy-sell agreements, that's just, if you, any business owners in this group, any business partnerships? No? Maybe yes? No? Okay. So yeah, that only applies to business owners. So if we don't have any, I won't get into that. So yeah, this is to protect yourself. And now to protect your legacy, few things. So you need a will and trust to protect your legacy. So the trust is essentially what your assets get put into it, so you avoid probate. And then the will essentially, will be like, okay, this goes to this person, that goes to this person according to your wishes. Another thing, a lot of people overlook this is performing a beneficiary review. And why I'm going to say this is, say you have a bank account, life insurance, or any other insurance, investment accounts. Those all have a beneficiary. Mostly anything that's a liquid asset has a beneficiary on it. You need a trust because your home, all of that, you can't put a beneficiary. So that's where the trust comes in to avoid probate. But most of your liquid assets, you have to put a beneficiary. Now, the problem comes, a lot of people forget to update their beneficiaries. It's, too old, it's an ex, or it's someone who already even passed away. But the problem is, even if it's listed in your will, I want this account to go to X person. If they are not a beneficiary on that account, whoever's holding that account will not care. They will only, the beneficiary designation will supersede the will. So if you can go and fight with them, like it is going to be, a battle, but they're going to be like, nope, this is the beneficiary on file. That's who this account is going to, regardless of what the will says. So it is very, very imperative to make sure all of your beneficiaries are up to date and your beneficiaries know where to find the documents for, say, certain accounts, insurance policies, whatever you may have. Make sure they know where to find the documents so they can also properly claim it. So yeah, this just kind of goes through the basics of a will. It will take effect after death and give you who gets what. We do recommend it being reviewed on a periodic basis, just in case there's any changes. You have a change in beneficiary, whatnot. Like you want to make sure these are up to date as well, because if you don't, if it's outdated and you pass away, I mean, you can't change it. It's going to be set in stone. So, like I said here, why do you need a will? To avoid probate, to make sure the state doesn't get involved, and your assets are passed on based off of your wishes rather than the state's wishes. And yeah, so we went through that. And then the trust is essentially, like I said, your assets that don't have, you can't put a beneficiary on it. It goes into the trust, and then the trust is like how and when the assets are distributed. So not who, but how and when who gets these assets. So absolutely need both. You need both the will and trust in California. You can't, if you have one without the other, very, very good chance you're going to end up in probate. So you need both aspects to avoid probate, especially in California. Yeah, so the trust, you put a trustee, and they're the ones who are going to execute the trust so that, essentially they're following the wishes in the trust and passing out the assets, and then the beneficiary is the one who receives it. same thing. We kind of talked about this. So a trust actually does protect you from creditors as well. I did want to mention that creditors, any divorce exposure, any estate tax, all of that. This does help you. This does protect you to an extent. So if this is why, you sit down with a estate planning attorney, if you have a lot of debt or you may have some kind of exposure from a family member, divorce, whatever it may be, or a huge estate tax, you do want to create these trusts and work it so that it helps you protect in that aspect. But trust can help with these things too, help you with protecting yourself and protecting your assets from any external stuff. Yeah, this is essentially another term in the trust. This kind of helps to, if you want to limit the control of how the beneficiaries have to manage the financials in the trust, you can essentially put a clause in there so they can't access it, or their creditors can't access it for a certain point. It's rare to see this clause, but we mention it here. And then most trusts are revocable. So your simple trust, like if you just have a home or whatnot, you want a revocable. You don't want irrevocable. That's if you have, high assets, you need to protect it from, the estate tax. That's where that comes in. But simple estate plan, revocable trust, because you can make changes while you're still alive. This is the one that you want if you just have a simple estate plan, just to pass on your assets. Yeah, we talked about drawbacks of probate, and I will actually skip through the irrevocable trusts. So I did want to touch on this because there may be a lot of members in the audience that does have a special needs child or adult. So included in your will and trust, you absolutely need to have a special needs trust. There are a few aspects because of there's a few reasons for that. One, to pass on to a special needs child, if you outright pass it on to them, then they may lose their government Social Security benefits like Medi-Cal, Medicaid, any other disability that they may be collecting. So if you're like, after you're passing, you just give the house or something to your special needs child, they can lose the benefits. Second problem, which is straight up passing on to your child, is they may not be able to know how to maintain it. So you don't have a custodian on the account. You don't have a guardian for them. So those are all listed in the special needs trust. So someone that you trust, because if you don't have this, the court is going to appoint someone for them, appoint someone as a custodian for their assets, and appoint someone as a guardian. Now, those two can be the same person, but they're going to appoint them. And that may not be the best fit for the special needs child or adult. Or the person who was assigned, maybe they don't want to do it. It's just like it's too time consuming, or they don't have the resources to do it, or they're not acting in the best interest of the child or adult. So the special needs trust, yes, it protects your child to make sure they don't lose their benefits, but also it protects them like, okay, someone is taking care of the assets for them, and someone is taking care of them for them that you trust and that you want. So this is actually attached to your will and trust, your will and trust that you have. This is kind of like a leg attached to it. And it's if you do have a special needs child or adult at home, imperative to have this, because if not, it will cause a lot of problems, and the state will just assign, and it's not fun. So, and that's why a lot of people actually, they do to preserve the public insurance, but also they use their insurance benefits, like their life insurance or anything that they pass on, they pass it through the trust so that they know, like, okay, you can designate, my child can only take out I don't know, like $2,000 a month or whatever it may be, you can mandate that to the trust, and whoever the guardian is, they have to follow that so that everything is not depleted all at once. So you can put rules like that. You can be like, my life insurance money is going through the special needs trust for my child, for my special needs child, and I'm dictating that they can only take out $2,000 a month, for example. So because if you just outright give it to them, they can do whatever they want with it. Or the guardian can do whatever they want with it, and it may not be in the best interest or what you want. Because especially life insurance, proceeds are all liquid. So that's liquid cash right there. So keep that in mind. Okay. So the last thing that we're going to talk about when it comes to estate planning is tax efficient strategies. So when you're passing on assets, there's a different tax for each person. Now, most of the call is probably not going to be subject to the 15 million or like the above $15 million estate tax. So I won't go too much into that, but there are certain ways you want to pass down your assets. So insurance, very, very tax efficient way to pass down your assets because it's non-taxable. Your children, or your heirs or your charity, they will get all of that cash tax free. I would say home, stocks and bonds, if you have any investments, stocks and bonds. The nice thing is you can pass it down, and the day you pass, everything steps up. So I'll kind of put this in numbers. So if you bought a home, I don't know, 30 years ago for $100,000 and it's worth $1 million today, if you sold that home today, you have to pay tax for $900,000. That's how much it has appreciated. But if you leave it to your next of kin, and when you pass away, the house is worth, say, $1.5 million. Now they're evaluated at 1.5. So if they go sell the house, they're not paying taxes from 100,000. They're paying taxes only out like from 1.5. So if you pass on the house to them and it was valued at 1.5 when you pass away, and they sell the house for 1.6, they only have to pay tax for $100,000. So it's a very, very good asset to pass down. This also works with stocks and bonds if you pass that down. The asset, especially now with the new laws that have changed in this decade, one of the worst assets to pass down is your IRAs or 401ks. Because a new law was introduced, it's called Secure Act 2.0, and it was passed in 2022. So if you pass on your IRA, so this is all pre-tax money. If you pass on your IRA to your next of kin or your 401k, with same thing, they have to liquidate it in 10 years. So if you think about it, it doesn't seem that much, but say you're passing down like I don't know, a $500,000 account to them. If you're adding on, if you divide that by 10, that's about $50,000 a year. They're adding that onto their income, depending on, depending on what else you pass to them, all of that. They have to pay tax on all of that because they have to spend it in 10 years. Before, they could leave it in there as long as they want. There was no problem at all, but the IRS shrunk it to 10 years. So the Roth IRA is the same thing, but the Roth IRA is not taxable. So it doesn't matter if they want to take it all out at once and use it, doesn't matter. There's no tax. But the pre-tax accounts, because a lot of Americans, a lot of their money is in IRAs and 401ks. So you pass that on, that's a huge tax burden that's being passed on. So those are your average American. These are the tax rules that are affecting the average person. And that's something that needs to be planned around. See what you are actually passing on and how it's taxed, and does your family know about it? Do they have the assets to pay for it, so on and so forth. That's where the planning comes in. So essentially, yeah, that's exactly what this slide says. So the estate planning process is, what do you have and what needs to be protected, who's getting what, and how do we save on taxes for you when the estate gets passed on. And that's the full plan, and that's kind of essentially where we come in to help. So that's so here I will end it with, this is my information here. So I will now that's pretty much all the content. I'll open it up for questions, and we'll take it from there. I did see something show up in the chat. Okay, what needs to be done so children do not pay tax on the whole price of home. So yeah, so that's the thing. Like I said, the step up in basis. Well, one, the house needs to be in a trust so that they don't end up in probate. You need a will and trust for it. You have that, that's good. If you don't have that, that needs to be set up ASAP. But yes, so that will avoid probate. Now, like I said, when you pass away, your home is valued at the time of death. So I'll say the numbers again. If you bought the house for $100,000, but when you passed away, the house is worth $1 million, and now the child inherits it, and they sell it for, I don't know, $1 million. Let's just say $1 million. Well, if they sell it for $1 million, then there's no tax there. If they sell it for 1.1 million, then they only have to pay tax for 100,000. So that's the step up in basis. So they're not paying tax from when you bought it at 100,000. They're paying tax only from when it was reevaluated at the time of death. Does that make sense, and does that answer the question, Tatiana? Yes, no, maybe.
I still don't understand. If
Okay.
the house cost more and it's sale for whatever it costs now, how to avoid paying this tax for the price that is nothing changing the house, yeah? It's just time that make it cost worse. So
Right.
what document need to be done to prevent paying all this tax?
So you can't 100% prevent the tax. There's no document. You have to put the document you need for the house is the will and trust, so it doesn't end up in probate. That is 100%, you need that. The only ways you can save on the tax, because when you pass away, the house will be reevaluated when you pass away, say your house is valued at $1 million, right? So forget about the amount that you bought the house for. Say it's valued at $1 million when you pass away and you pass it to your next of kin. Now, when they inherit it, they can keep it, which is fine. But if they sell it, say they sell it for, I don't know, like $1.2 million. Let's just say that. Or yeah, let's say $1.2 million. They're only paying tax on $200,000. The capital gains tax, which is I think 20% right now. You can't avoid that. There are certain deductions you can avoid, but you can't avoid the capital gains tax. But you have to keep in mind, you probably bought the house for $100,000. And if they sold it for $1.2 million, they're not paying tax for, I can't do math, for $1 million. They're only paying tax for $200,000. So that's the savings there. That's the tax savings. You can't 100%.
What makes this saving? What documents make this saving?
Oh, it's not a document. It's automatic. So when you pass away, the house will automatically be reevaluated, and that will be in the county records. So yeah, they just have to go submit your death certificate to the county record so that they can inherit the house. And then it will automatically be reevaluated. Yeah.
When
When the
both,
second person goes.
then the beneficiary there.
Does that make sense? So yeah, that's after your passing, your kids have to submit the documents to submit your death certificate to the county, and then they will automatically reevaluate it for the future savings.
So they don't pay all the tax for $1 million, no?
Correct. Yes.
I still don't understand this. Okay,
Okay.
thank
Yeah,
you.
no, it's okay. My information's here. Feel free to, text me or email me, and we can do a one-on-one, and I can happily explain it to you a little bit more. I do have a few other questions, but yes, we can do a one-on-one later on.
Thank you.
Yeah, no problem. And okay, so from Lori, let me just do the ones in the chat first. It says, we set up a special needs trust for my son when he turned 18. He's now 23. It's not funded. Explain how it works. When do we add money to it, or is it funded when we die? So,
Do you want me to answer this one?
yeah, you can answer it. Yeah, I mean, I was just gonna say it's if you have it attached to your estate plan, it's automatically funded after you pass away, but you can also fund it during life, which is actually recommended, to be honest. But Alexandra, go ahead and answer it a little bit more.
Yeah, so I mean that's basically it. You can decide to do it either way. The real thing is you want to make sure that when you're doing all that estate planning stuff that Jennifer was explaining to us so well, you are naming the trust in your will and estate documents. That you can leave it totally unfunded until your death, but you want in your will to set and your life insurance policies to say the beneficiary is the special needs trust and not your son directly. Like that's the best way to do it.
Yes. I'll say that's the only way to do it, especially if you have a special needs child. The beneficiary should not be directly them, because it can cause problems in the future. If it's through the trust, you got a guardian, you got a custodian, and it will be distributed to your special needs child as per your wishes. You give it directly to them, you're going to run into problems. So that's where we kind of help, and that's why the special needs trust is attached to your will and trust. Yeah. Does that answer the question, Lori, before we move on? Yes, no, maybe. Yes, okay. Sandy?
Sandy?
Sandy? Okay. Go ahead.
Okay, you had mentioned about the spendthrift provision, and I hadn't heard of that before, and for a trust. And does that mean you can put conditions on how frequently and what amount of money could be taken, given to a person? Could you explain that a little bit more?
So you can do just about whatever you want. Now, the more you want to do, the more complicated the trust is going to get. And so the attorney will just have to put these clauses in. Like I was saying, the spendthrift one, not as very, because a lot of people, what they do is just they pass it on and they're done with it. They don't put any like, oh, you can only spend it for this, or spend how a specific amount every month or whatever. But
Or
if you,
ages, or
yeah, ages is another one. But you can put all of those clauses if you choose to do so. And it can be for specific assets too. If you're like, oh, I don't want my beneficiary to touch my life insurance proceeds until they're 25. And even when they touch it, you can be like, they only get, I don't know, $10,000 a year from that fund until it depletes. So you can add all of those clauses. Now, if you add a bunch of clauses, it gets a little bit more complicated, but you can pretty much do just about anything. Age, how it's paid out, what it's coming from. You can even, like, for some homes and stuff, you can also even dictate in the trust that it needs to be stayed in the family, and it could only be sold to a family member. You can even put those, you can do that. Yeah, you can also, if you have a lot of collectibles, you can be like, okay, this specific thing goes to this person, all of that. You can do all of that. It really, when it comes to these trusts, like the world is your oyster, but it does, it does make it a little bit more complicated. But if you are adding clauses, that's when you definitely want to sit with, a financial professional and an attorney to make sure it's airtight. Because as the more clauses you add, it can be like, oh, it can be a lot of, or you're opening yourself more to like disagreements and dispute and all that. You just want to make sure those clauses are airtight.
Okay, thank you for that. And my child is under SSDI rather than SSI. So
Mm-hmm.
she could have money, whatever money I'd want left to her, and that wouldn't kick her off of that. Is that still true?
That's correct. And that's why you need that special needs trust.
Yeah, we
So
have that.
yes, yeah. So just make sure the beneficiary, whatever you have that you're going to pass on to her, like Alexandra was saying, the beneficiary needs to be the trust.
I have to make a judgment. Some
Right.
could go to her
Yes.
if I judge that that's proper, but
Right.
that could be controlled through this spendthrift kind
Yes.
of.
Yes.
Okay,
So
thank you.
let's just don't pass it. Oh, so yeah, you probably have other heirs. So yeah, you can pass it
Yes.
directly on to them. But for your special needs trials, so they don't get kicked off of SSDI, whatever you're passing on to them, make sure it goes through the trust. Because if you do it directly to them, they're gonna get kicked off of the SSDI.
Oh,
Yeah.
I don't think that didn't used to be true.
SSDI, you're fine. SSI is the one that you would get kicked off of if you
Right. I
don't.
just wanted to be
Yeah,
sure
yeah,
that was still true.
Yeah.
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 No, that's still true.
Okay.
Okay, thank you.
So
I have a
whatever,
question.
it's just best to have it go through the trust, whatever is going for for your special needs child, just because it's there's
There's complications, but
yeah
thank you.
yeah. Um, any other questions from like raising hands before I go back to the chat?
Jennifer, can you hear me? Hello?
Yes, I hear you.
Okay.
Yes.
Yeah, I want to thank both of you guys. Jennifer, Alexandria, thanks so much. It's very enlightening. And frightening at the same time. Um, two things I want to bring up. So my wife and I have an A and B trust set up, and that means
Mhm.
whoever goes first, the remaining part of that trust will take everything that's in that we have. But
Mhm.
but when we're both gone, then
Mhm.
then what you said was that we should basically name a beneficiary like my son, for example, and then we have to be concerned about the tax implications of that, correct? Um, because
Yes.
yeah. And this question is for Alexandra. Um, so JLA Trust basically offers fiduciary services, and it's a pooled trust that you guys
Yes.
work with. Uh, would the beneficiary on a special needs pooled trust, would name JLA Trust
You
in
wouldn't name JLA Trust. I don't know the exact language that you use, but it would be their trust within JLA Trust. Because if you name JLA Trust, you're naming the whole organization, and obviously you want the money to go to their trust. I'm sure that, like, if you go through the process, like that's a question for our trustee. Like they know exactly, but it's something like trust for the benefit of your kid within JLA Trust. Like there's a specific language that they have, but it's not JLA Trust generally.
Yeah, so because what we have is special needs trust, and it's funded, and but we don't have anybody a fiduciary to assist when we're not here, and
Yeah,
that's why like a pooled trust like JLA or whoever or some fiduciary named would oversee all of those funds in that trust, correct?
that's
Uh,
correct.
so, but
That's what we do.
it sounds like
Mhm.
what I have to do is we have, let's say we have 175, $200,000 in the special needs trust already funded, but it sounds like we would have to somehow use that money up before we would be able to get into a pooled trust. That's
That is not true. I don't know the exact specific process, and I can connect you to like the intake people within JLA Trust that do know. But you definitely like there is a way to convert an existing trust to a pooled trust and like name us as trustee if that's what you are interested in doing. Like you don't have to spend down that money before you do that if that's what you want to do.
yeah.
If you want to, I can put my email in chat and I can connect you with the right person who does our intakes, who knows all of that. Because that's like, I know that we can do it, but I don't know the full specifics
So
of it.
the issue is, Alexandra, thank you, is that
Yeah.
it's an irrevocable trust.
Oh, okay.
So given that it's an irrevocable trust, that means that no changes could be made. And, the trust couldn't just be turned over to you guys, for example, because it's already irrevocable. So, yeah, I mean, at the time we were told it's a great idea to have the special needs trust, but, in retrospect, because she has Medicare and she has, all of the, those services, I want to make sure that, that they don't take that money from her.
Yeah, of course.
There.
So all special needs trusts are irrevocable trusts. Like they have to be, that's part of like the legal definition of what a special needs trust is. Like they just have to be an irrevocable trust. I
Yeah.
think there may still be some way, because I know that people have done it where they've had this trust and they've moved it to us. So, I can certainly ask and I can certainly put you in contact with someone. I'm not 100% sure since you seem sure about your situation, but I do think it's possible.
Okay. Yeah, Alexandra, if you want to pass along your information in the chat there,
Yeah.
I'd appreciate it.
That's my email. Send me an email and I will get you in contact with probably Ron, our trustee.
Carol kind of answered the question. An irrevocable trust can be amended by a court order, which, yeah, depending on the circumstance, that's a possibility. It's a route. But that more is you would need to seek legal counsel at that point. Yeah.
Yeah.
And what was your second question?
I don't know. I have so many.
That's okay.
So little time. Are you, Jennifer? So you are a financial planner yourself? Is that correct?
Yes, I'm a financial planner. Yes.
Through Eagle Strategies. So we
Yes.
could essentially hire you to look at our plan. You're not an attorney though, correct?
No, I'm not an attorney. We do help with basic planning, wills and trusts, but even specifically in your scenario, like I would recommend you go to an attorney. We do have some that we refer out to if you need, like for the estate plan, for your will and trust. We recommend it. Do you have, besides the special needs trust, do you have a will and trust for yourself? Yeah, you said that in the beginning.
Yeah, we have, it needs to be updated. It's like over 20 years ago.
Yeah,
So
yeah.
it really needs to be updated, but we have a will. And
We never wrote the will.
and we never really finished that. And then we do
Mhm.
have the A and B trust and the special needs trust set up.
Yes.
And my main concern is because we fit into that scenario where we paid, 45 years ago, we paid X dollars and now it's off the charts. And I don't know quite, I made a note here that the house needs to be in a trust to avoid probate. So I'm not sure how that works because right now I think the trust is the house is in the A and B trust. We didn't name a beneficiary like my son, for example, on that.
Well, you can't name a beneficiary on a house. It
Oh.
has to be the trust. Yeah.
Yeah. Okay.
Yeah.
So we
Yes,
should
and-
establish a
yeah.
trust then. I mean,
Yeah.
yeah, we did. But it's only in the A and B trust.
Yeah. Yeah. So what we can do, so I put my information. I know I saw a
I have
question.
that. Yeah, I have
Yeah,
that.
so someone couldn't say, Carol couldn't send or see the information. So I put it, my email's on, oh, no, my email is not on there. So let me put my email. Oh, my phone number is on there, but my
You
email.
know, I have all the information. I see that on here, your phone. Yeah, your hearsay number. and your phone number. But yeah, I
Yeah.
mean, at this point in time, we really seriously want to make sure that we have everything in place, and
Yeah.
so it's been very helpful, beneficial. I
Yes.
don't have, I mean, I probably have other questions, but is this presentation available? Are you going to send a stack of slides on this or?
Yes, I'll send out the slides. I think someone else had that question too. I'll send the slides out. That's my email. So
Okay.
I can just, if of course, Alexandra, you're okay with it. Anybody on this call, I have my Calendly link here. I will do a complimentary one-on-one, 1 hour session for, as like a thank you for attending this call.
Okay.
So you guys can book it through my Calendly. I just put my email on here. You can call me, whatever, however you want to schedule it. We can do that. So yeah, kind of as a thank you and thank you to JLA Trust, I will do like a complimentary one-on-one session where any one-on-one questions like this I can answer because sometimes it's hard in a group setting to answer all the questions.
Yeah, and I don't mean to take up any more time, but again, very valuable, and I appreciate you guys having this.
Yes. All right, few more questions from the chat and we'll maybe wrap up in the next 5 minutes. Okay, so Tatiana, what is the main effect of revocable and irrevocable trust on tax? So revocable, it has no effect on your estate tax. That's just there, like you have it so you avoid probate. That's not going to help you tax-wise in any way. The irrevocable trust, yes, it does because it removes whatever asset you put into the irrevocable trust, it removes it from your asset or your estate. It removes it from your estate. So then that's where the whole estate tax and all of that comes in. So the irrevocable trust becomes a completely different entity. So people who are in that very, very high tax bracket, maybe they have a lot of assets and they need to lower their estate. If gifting is not enough, if any of that stuff is not enough, that's where the irrevocable trust comes in. It removes those assets from your estate and lowers your estate tax. Now, the problem with the irrevocable trust, which we kind of mentioned, is very hard to change it. So that's why if you're not above that estate tax threshold, I wouldn't recommend a irrevocable trust. This is only for your will and trust. The special needs trust, whole thing of its own. I'm just saying for your will and trust.
Okay. Okay, great.
Yes, so that's Tatiana. I hope that answers the question there. So revocable, no effect on tax, just gets you out of probate. Irrevocable can reduce your tax, your estate to reduce your estate tax burden, but then you're not able to make any changes. So just keep that in mind. So you don't even need to deal with that if you're not above the 15 million for your trust, not for the special needs. And then from Lori, can you put the special needs trust as a beneficiary in an investment stock account? Yes, you can. You can put a trust as a beneficiary there. And yeah, that's it. Because everything else was just my information. I put it on there. I'll send the slides out, no problem. Yeah, that's it, I think, when it comes to questions.
Yeah, thank you so much, Jennifer.
Yeah, no worries. I hope everyone got a good amount of information from this.
Thank you, Jennifer. Yeah, so I'll send an email to you and we could schedule a 1 hour with you.
Yes.
Yes.
And when I
Yes.
send out the slides to everyone, I will include Jennifer's contact information and her Calendly link.
Great,
Yes.
great.
So I'll get that sent to you as well. So there is an attorney on the call, but she's no longer providing advice. She already
Good for you, Kara.
I love it. All right. And if there's nothing else, I mean, I don't know, Alexandra, if you had any last
No,
minute.
that's it.
Thank you. Thank you so
thank you.
much.
Thank you all so much for coming. See you next time.
Thank you.
All right. Thank you. Thank you, everyone. Bye.